As we continue our coverage out here near Whitman, Nebraska, it's that time of the show where we like to look at what's happening in the markets, and in this week in particular talking about the livestock markets, because we're talking cattle, of course, at the Gudmundsen Sandhills Laboratory. Elliott Dennis, University Livestock economist, fresh off your presentation, as all the cattlemen want to know where are the prices headed. In particular, I think as part of your discussion, you looked at the fall, because those are some of the decisions that have to be made right now. Give us your prediction. What are your thoughts?
Yeah, so really I think it's kind of where the cash market's at right now, and when we're really thinking about that, it says, well, prices have been coming down a little bit. So when we think about where we're at in October, November, as we start thinking about weaning, kind of where prices could be at for both 5-6 weights and also 7-8 weights. Bulk of the presentation was on 7-8 weights for just price forecasting. And really I kind of see that price using a combination of just about 285, which would be kind of about average of where we're at if we just kind of maintain the market. But really there's this deviation. We think about kind of going into the kind of the latter part of the year. About 289 is what I would kind of was projecting there, which would be a deviation from the last year trend. Generally we start to come down a little bit. But it's not just that price, 285 or 289. It's all where the distribution of is, or how likely are we to achieve that price. And so one of the ways that we're able to do that is we take kind of futures options data from the CME group, and we can basically make a whole bunch of assumptions and then say, okay, what does that price distribution look like? And essentially at that price, we're about 20% of the time we're going to be higher than that price. Essentially, there's a lot of downside risk in the market right now, especially being priced in on different weather events from different kind of policy decisions. And so I think even more so, even though there's optimism for prices to go up, I think there's a lot of downside risk in the market right now, and maybe we need to be thinking about kind of protecting either the LRP or futures or options in the market, even though we're optimistic about kind of where that supply situation could be.
Optimism is always a good thing at these kinds of field days and in the cattle industry broadly, but bring out the pessimism here. Why that downward pressure that you're seeing? Where's that coming from?
Yeah, really from two areas. I mean, consumers have been exceptionally resilient, and we have to have a lot of appreciation for that. If we think about like how much beef actually costs, it's almost $10 on an all fresh beef index. And so that's extremely expensive when we think about they've experienced these prices for 2 or 3 years. Consumer debt is rising, delinquency rates are up, interest rates haven't been coming down. So there's just a lot of pressure when we think about disposable income of consumers. Can they continue to support higher prices? And there is some softening in what we're seeing in some of those consumer valuations. That's the first thing. And then we think about kind of the export market. Kind of going into this fall, we're going to be entering kind of this interesting situation. China has really kind of come off the books a little bit. There's some, things happening with trade negotiations. So the question is, do we go back to 2017 to values, which China was a zero trading partner? Now they're our third largest. So I think there's some of those kind of discussions starting to happen, like how much of this is going to really affect the industry. Well, if we don't need China, then maybe our supply situation is solved. So I think those two, exports and also kind of a softening domestic market, can really impact total pounds of production that we need to actually produce.
Mm-hmm. Fair points. Appreciate you bringing that up. Let's really look at what's happening in the markets this week, in particular on the futures. We factor in last week's cash. Things are softening a little bit here, and there's some worry out there as you talk to people, anecdotally. As you look at what's happening, losing a few dollars, on a Tuesday here in the live and feeder cattle markets, is this perhaps just a little bit of a downward trend this week, or perhaps a sign of longer-term downward pressure?
Yeah, so I always think about a particular contract that I'm focusing on. So we think about the October contract for feeder cattle. There's going to be some situation where the price has to come and meet futures, or is futures going to come down? And I think what we're seeing is kind of both kind of markets kind of moving together. Some of that has to do with different announcements and different kind of information out there, like we're testing more for bird flu and ground beef, even though it's safe. So I think there's some of those kind of worries kind of being priced into the market right now. I think there's also a little bit of uncertainty on policy-wise, kind of we're going into an election year, like what those policies could be. So I think those things are getting priced in. But overall, I mean, eventually we have to come to some sort of agreement, and that's where we have basis. I just see prices coming down a little bit, but as we mentioned before, kind of that fall outlook, I think we've kind of reached somewhat of a level of resistance, maybe plus or minus $2. But this is just my own thoughts, kind of where forecasts. Obviously, if you have other shocks or more information comes out, those forecasts are updated. But kind of see we're kind of hitting the bottom, and prices can really maintain throughout the fall.
Mm-hmm. Well, you and I talked about this last time. You were on Market Journal. We don't have a July cattle inventory report to talk about and analyze about where the cattle inventory number sits in the U.S., but general feel out there is we're not herd rebuilding, at least in large droves at this point. How soon do you think it'll be till we see that day?
Well, cow-calf producers are estimated to make about $650 a head this year. And so when we think about kind of where that value is, there's definitely economic incentives out there, but we do have higher prices. So I think we can see some rebuilding happening in 2025, but I think the real rebuild will happen in 2026. We do have the January and July report, but there is limited amounts of information now. But what we do find is that even in the spring calving herds and the fall calving herds, we're down still about 2.5 on the fall and about 1.5 on the spring calving. And so these are pretty substantial numbers that we just can't get away from. And we think about kind of where that value is in the market. It has to really come from, retaining cows and rebuilding. So I think 2025 is when we're going to see that start. 2026 being kind of like the boom year. But once again, it's all dependent on consumer demand and kind of keeping strong value there, kind of what the feedlot starts to do and mix that kind of weights of cattle that they're bringing to the market. We've seen this past summer that they're able to put on a lot of weight if they want to.
Mm-hmm. There's a lot of factors and things to be watching in the cattle industry. You make it all sound simple, so I appreciate you joining us to do so. Elliott Dennis, University of Nebraska-Lincoln Livestock economist, our guest here on Market Journal.